Well, good morning, everybody. Welcome to our next session here. My name is Jeffrey Beamer. I am the Senior Investment Strategist over at ewotrading.com. And we today are going to talk about Earnings Edge, mastering breakouts with straddles and strangles. So we are going to talk about utilizing an options strategy, or actually two of them, and focusing on earnings events. And why would we talk about earnings events? Well, we are in the heart of earnings season right now. This is the first big week of the next earnings cycle, and we have all sorts of companies that are declaring earnings this week. So let's get started. I have to throw up this little disclaimer here for us. You've seen many of these before, so please feel free to pause the recording if you're watching the recording, or glance through it as we're live. Um, but we need to get this out every time we do one of these presentations. All right, so let's get into it. Once again, Earnings Edge here today, and let's talk about what we're going to cover in this session here. I'm going to do an overview of the strategies. For those of you that are beginners with options, this will be very useful for you. For those of you that are more sophisticated with options, well, I have something for you as well. All right, we're going to talk about understanding this strategy. This is a basic, simple strategy for you to use. There's no margin required in this. And we're going to talk about some resources to find upcoming earnings. Now, I'm going to put all the pieces together. Why do we talk about straddles and strangles? Why do we talk about earnings events? I'm going to answer those questions here in just a little bit. We're going to talk about identifying behavior patterns, okay? Because not just earnings, these strategies are good with other chart patterns as well. But there is a little secret to it, and I'll talk about that here in a little bit. I'm going to review just one Greek, and that's implied volatility. Okay, and we'll talk about that and its impact on this strategy, and then I'll talk about how to access a service that does this strategy, that puts out the trade alerts for you, that I run over here at ewotrader.com. All right, so let's get into it. For those of you not familiar with me, my name once again is Jeffrey Beamer. I am a former hedge fund manager. I've been in the industry for over 35 years, well over 35 years. I've been the founder, general partner of multiple hedge funds, mutual funds, and investment advisory firms over the years. I've been very active in the investment industry for all my career. I have been part of many associations and industry groups, including the Security Traders Association. Okay, I'm the past president and executive board member of the Security Traders Association, the Dallas chapter. I was also the chairman of the Dallas chapter of the Market Technicians Associations. So if you're not familiar with Market Technicians Association, then this is the group that certifies a designation for called the CMT designation, the Chartered Market Technicians designation, which is similar to a CFP, CPA, any of the other professional designations here in the trading industry. All right, so I'm also a former member of the National Association of Active Investment Managers, name that group. Those are just some of the groups that I have been very involved with over the years. So I'm still a member of a few of these associations. I still take part. I'm just not as active as I used to be. All right, so I spend most of my time in front of the screen and dealing with markets. So let's get right to it. That's a little bit about me. And now we're going to focus on the strategy and really how to make money with these strategies. Okay, so setting up the trades. All right. Now, earnings are a popular target for many option traders. I mean, they're in the news almost every day during earnings season. They talk about, oh, this stock moved this on, based upon earnings per share and revenue and gap and non-gap and what is all that. Well, guess what? We don't need to really go over that. We pay attention to something different, which I'm going to focus on here in just a moment. Okay. most traders are unsuccessful because they either pick the wrong direction through the earnings event or they just did the wrong strategy. Okay. Maybe you learned about vertical spreads and you did a vertical spread and then the stock moves the opposite way. Okay. We're going to talk about a strategy that can solve that problem. All right. Now, I've been consistently successful with a strategy that where others have failed to work. And I can make that statement because this is a strategy that we teach when we teach trading and teach people about options. It's really one of the very first strategies that we talk about. Yet a lot of instructors, and I've been guilty of this, we fail to talk about certain things that need to happen for the strategy to work. We focus on the education of the strategy, but application is a little different. And you want to make sure that you have the right situation to apply a certain strategy. Okay. So, for example, if you see a stock that's consolidating, okay, that's trading sideways, well, a straddle or strangle is not the right strategy for you. All right, you need to focus on a different strategy, a different option strategy. But here, we're focused on earnings and stocks that make typically big moves around those earnings events. All right, so I'm going to show you this on how to profit when a stock either goes up or down, okay, around the earnings event. So let's jump right in. I do this through a service called the Delta Neutral Breakout Service, where I do all the research, I provide all the information on the upcoming earnings and the best opportunity to take advantage of that. We utilize a strategy to capitalize on the stock volatility around earnings and to profit regardless of market direction. So we target stocks that are typically volatile through their earnings announcements. Now, believe it or not all stocks are volatile around their earnings announcement. In fact, just this week we have many companies that are just don't move very much. For example, one that comes right off the top of my head is U.S. Steel, for example, symbol X. That stock just doesn't move very much. It moves maybe 2 to 3% through the earnings event. We're looking for other companies. Intel, for example, has earnings this week. Intel has been known to move a little bit through earnings, and we'll talk about this and which are the right types of stocks that we want to be trading with this strategy. Okay, so we profit from two different things. One is the breakout move itself, either the stock gapping up or gapping down through earnings, or something called IV rush. Now, IV rush stands for implied volatility rush. This deals with one of the Greeks of options, and that is implied volatility. All right. And we'll talk about how that impacts option pricing as we go into the announcement. We're going to talk about both straddles and strangles. There's a subtle difference between the two. And we'll talk about both of those as we move through the session. So let's begin with building a straddle. Now, I had a call with a colleague of mine this morning who I'll introduce a little later, and he was telling me that a lot of people don't know that when we build a straddle that's built with buying a call and buying a put, that they didn't even know that they can do this at the same time, that they can buy the call and buying the put at the same time through their broker. And you absolutely can, and you absolutely, in most situations, want to do this, do them at the same time. So let's talk about this a little bit. So the construction of this is simply by buying a call and buying a put, okay, together at the same time. They have the same strike prices. Again, this is the straddle with the same expiration date. Okay, that's it. Call and put, typically, at the money. Okay, same strike prices, same expiration date. This is a good strategy if you think the stock will experience a large price movement in the near future, but are unsure of the direction. Okay, now, for example, biotech stocks, great sector. If you happen to, you know, be reading up on a certain drug that's pending FDA review, and you think, wow, this might be a really good opportunity. Well, you can apply a straddle around that, and you're looking for that catalyst. You're looking for that event. Okay, and so when the FDA either approves or denies, usually we get a big move in these stocks around that. The critical thing there is timing. Okay, I'll talk about timing in just a moment. But that's how we build a simple straddle. A strangle, before I move into risk graphs and risk curves, is simply buying a different call. Okay, the different strike prices, a call at one strike price, a put at another, and then same expiration date. And I will show you examples of these here in just a few moments. Now, one thing that I like to do as an option trader is I like to model my trades, and we use modeling software to do this. Most brokers, okay, most brokers now have basic modeling on their platforms. Okay. I know this because I use several different brokers and I can see their option modeling basics through those. All right. Because I like to visualize my risk and visualize where um, I need the stock to go through the event. All right. But the basics of modeling, okay, you have your profit and loss calculation, then you have your horizontal stock price along that axis. And usually we label the strike prices along that stock price axis. Now, if you buy stock, okay, if you bought a stock at $50 a share, this is what modeling your stock looks like. That is the risk graph of a long stock position. You have unlimited reward to the upside, you have unlimited risk down to zero on the downside. All right, that is modeling your stock. And that's what we call, actually, what we call here on that position, that's called a naked stock position. Okay, we call it a naked stock position because there's no hedge, there's no protection on that position. All right, now, if we incorporate the straddle, we begin by buying a call. And here you can see that we have unlimited reward to the upside, but we have limited risk to the downside. What's our risk? Well, that's determined by the price of the call. And in this case, it's $2 in our example. Okay, so $2 to buy this call that has a certain time to expiration, and that is where we would benefit from upside movement. Now, simultaneously, we would then also buy a put, a long put. Okay, buying a put, going long a put, going long a call. And essentially, here, now we have unlimited reward down to zero on the put side, limited risk to the upside. Now, how on earth would this trade make money? This is called being delta neutral. Okay. You're pretty close to being zero. If you buy, for example, a share of stock, you have a delta of 1. If you bought 10 shares of stock, you have a delta of 10. If you buy 100 shares of stock, you have a delta of 100. Well, options, an at the money option, okay, an at the money call has a delta of approximately 50, and a put has the delta of approximately a negative 50. Okay, just the opposite. So now you add those two together and you have a delta of approximately zero. So how does it make money? Well, how it makes money is through the straddle and when these stocks go in the money. Okay, when these options go in the money. So here we add the two debits up. So $2 for the call, $2 for the put. Our debit on this trade is $4. Of course, we multiply that times 100, so it would be $400. Okay. And as you can see now, we have unlimited reward either up or down. However, there is a little risk area, as you see in the middle, where I might lose money. And we're going to talk about that in just a moment. So, using an option chain to build this straddle. All right. So, that was a very, believe it or not, very simple way to build this strategy. I mean, it's really the only way to build the strategy. And I'm going to show you here on a option chain an example of that. Okay, so usually with your brokers platforms, you pull up the option chain that of the series of options that you want to trade, and here we have a strike price of $50, and on the left hand side of the ledger usually are calls. On the right side of the ledger are usually puts. All right, and you can see here that they debit the price under price column is $2. Under the delta column, you'll see the positive 50. And then on the right side of the ledger, you'll see the debit of $2 and the delta of negative 50. All right. Now, some brokers allow you to pick a strategy and it will auto build the strategy for you. Okay. And so when you do that, you can just pull up Straddle, and you can then go through and see the different pricing. Like a straddle with an 84 delta is going to be 624. That's an in the money type of situation. You go at the money, okay? So at the money, and you can see delta of 0 on the right, $4 on the left, and then the opposite effect. If you go down the list and you're deep in the money on the put, you got negative deltas, and they get more expensive, obviously. So at the money gives you the best opportunity because you are anticipating the stock to go either direction. You're not favoring one direction or another. Now, I'll give you the simple answer of how this makes money right now, and I'll repeat it in a minute. And that's through something called gamma. Okay. Gamma is the turbocharger of delta. Okay. You're delta neutral, but what you're not seeing is the gamma number, and the gamma starting to infuse into the delta number. Again, that's a different course. All that conversation. Just realize you can make money if this stock all of a sudden gaps down to $44. What is this straddle going to be worth? Well, you can see it's going to be worth about $6.12. Your debit was $4. Your profit is, or your now value at $6.12. That would be a profit of $2.12. I'll show you more of that in just a moment, and how I calculated that really quickly. All right, so there's your straddle. If you choose that strategy through your broker's platform, if you choose straddle or strangle. All right, and let's take a look then at the strategy in action. So capturing a breakout. All right, so through this then we have a strategy where, again, we're looking for a move up or down. So you buy your call, you buy your put. Your debit now is a combination of those two prices. You're looking for a stock to move. And then if it moves higher, you have what's called an upper break even in the trade. If the stock moves lower, you have a lower break even. Now, how this is calculated, all right, is very simple. You take your strike price to get your upper break even. You take your strike price plus your debit. My debit here is $4. So in this situation, I need the stock to go above $54 to make money in the trade. Okay? I need the stock to go above $54 to make any money. Otherwise, I'm going to have a loss. Anywhere from max loss to minimum loss would be at my upper break even before I move into profit. On the put side, it's just the opposite. It's your strike price minus your debit. Okay? Strike price minus your debit. And that gets you your lower break even. So it's really, if you don't have any modeling software, or your broker doesn't have any modeling software, this is one of the great things about this strategy, is that you can calculate where you need the stock to go. So if the stock moves, say 10%, that's a $5 move. If it jumps 10% and it's at $55, I can calculate how much I'll make on that trade. And the answer is $1. Okay. I'll make $100. $1 times 100, $100 on the trade if it goes to 55. How do I know this? Well, it's 55 is obviously $1 above 54, and that 54 is my break even. Conversely, if the stock drops $5 and goes to 45, again, same thing. I can calculate where my profit is. Same profit, a dollar, because I need it to drop below 46, and it did. It got to 45, and I can take my winnings and move on to the next trade. All right. So essentially here, I'm going to show you in a minute how we calculate out where the opportunity is, because when we talk about, I talked a moment ago about earnings per share and revenue. Again, we don't focus on that. What we focus on is what the market makers tell us. Where are the market makers in this price? They are incredibly good at estimating prices, similar to Las Vegas bookies. I mean, no doubt it's very similar in concept. Okay, the market makers are pricing in the estimated move of the stock over a certain period of time based upon upcoming events, including earnings. All right, so if a stock, say, if the market is pricing in a stock to move 10%, and my trade is priced at a 10% move. Remember, okay, here is say my options cost me $2.50 a piece, and that would be a $5 debit. So now I need a 10% move, and I look at the pricing, and they're pricing in a 10% move. That's not a good trade. Okay. But if the market makers are pricing in a 2% move and the stock moves 5%, well, now we're talking. Now we are able to profit. So it's nothing about earnings per share and GAAP, or are we using GAAP or non-GAAP? All right. All that stuff is for people that think they're smarter than the traders. Okay. And guess what? The market makers are usually correct. Okay. Not all the time, because we do find an edge here and there. All right. So if the market drops, we need to drop below that lower break even to make money. Okay. If it moves higher, we need it to get above that upper break even to make money. And then if it stops in the middle, well, then that is where our risk is in the middle of the situation. Now, what I do is, in my modeling, what I do is I am, through the software I use, I'm able to flip over the risk graph, rotate it 90 degrees. Okay, so it goes from horizontal to vertical. And the reason I do this is then to incorporate stock price, where I can see, as I look at a chart, I can see that, hey, the stock is either going to move higher or lower, based upon whatever technical pattern it is. But earnings, well, earnings change the whole game. Earnings just they turn everything on its head. Okay. And you just never know. A stock could be in a downtrend and then all of a sudden move up 20%. Okay, based upon earnings, and it changes the whole dynamic of the current pattern. All right. So how we are going to do this is we want to place our trade before the earnings event, not after. Different strategies are used for after the earnings. So this strategy, straddles and strangles, are used before the earnings event. So we need to identify that earnings date. Okay. We calculate the upper and lower break even, and we're looking for that move higher. All right. Now, this is an example, okay, of let me kind of back those arrows out and talk about how the two ways that we make money, which I mentioned earlier, and I've been focusing on price movement. The other way is through implied volatility movement, okay? And I'm going to show you this visually here in just a moment, but implied volatility rushes into options and makes options more expensive. Implied volatility can rush out of options, called an IV crush, and make options less expensive. Okay. So one way if we put on these trades, we can profit from IV rush. Okay, we can actually make money, sometimes even double digits. Okay, 12%, 18%, 20% profit in our trade before the earnings event even happens. And that is accomplished through not only stock movement, but through IV rush. Okay. And this is a phenomena that happens around every earning cycle on every stock that has options traded on it. Okay. Talking about that IV rush. We also can profit then after earnings when we do get that IV crush, because IV will drop after the earnings announcement. Okay. Guaranteed. And you can't use that word in trading, but it is bound and sure that the IV will drop. You will have IV crush after the earnings announcement. IVs get less expensive. But how does the straddle make money? It's because the delta in the calls, like if the stock goes up, the delta is in, it gets a price action from the gamma. The option goes in the money and has something that we call intrinsic value, no time value. Okay. No time value, just intrinsic value. That's real value of the option. Now, the put side in this case, and I'm talking about the stock going up, it will lose value very quickly because it's out of the money. It has only time value. Now, the opposite is true if the stock drops. The puts go in the money, okay? They have no time value to them. They have all intrinsic value, real value. Yet the calls have lost all their value, okay? And that is where the cost of your trade comes into play, and it's very easy to calculate, just like I did for you earlier. Your strike price plus your debit, or plus your debit and minus your debit, get your upper and lower break evens, and then the stock will you can calculate your profit based upon movements above the strike price and below the strike price. And I'll show you examples of that. Okay. So three-step method to finding explosive stocks. Okay. Yeah, just 3 steps. All right. One is, well, you build a list. Okay. You simply build a list. What you need to do is find a list of stocks that have upcoming earnings announcements. All right. You can simply do this by Googling or using a trading software that provides these lists. I use a service called tomsoptiontools.com, which I'll highlight here in just a few moments. But there's other sites like Yahoo and Seeking Alpha. There's Reddit. There's all sorts of places to get lists of upcoming earnings. They're readily available and they're free. Okay, so that should not be a problem to find those. All right. Now, second step is to identify trading patterns. Okay. So some stocks exhibit a consistent behavior around earnings announcements. All right. They may be quiet going into earnings, or they may be extremely volatile. And either is leading, either they are either quiet or volatile leading into or immediately after the earnings announcements. Okay. So some stocks are really quiet, some stocks are volatile, and that's what we're going to find is the volatile ones for this particular strategy. So we're looking for stocks that have exhibited irregular volatility or explosive movements around the earnings times. And the good news is here you can see it on a chart. Okay, you can see it on a chart. That is the great thing about this. So let me give you an example. All right, so here's Yum Brands. Okay, this was through last year, okay, 2024. You can see here I've got the not only the earnings events identified through the vertical red lines, but then I have a trading range that this stock has been in. Okay, so this is what's known as a quiet stock. You can see here on the first earnings event back in February of 24. Look at that, the stock just moved a few percentage points. Really, I say in my methodology, I call anything under a 10% move a quiet move. So if you have a single digit move, you're looking at a pretty quiet stock because there are an enormous number of stocks that move double digits or more through their earnings announcements. But this is just one of them. Even that gap right there is only about 2.5%. Okay. So through the earnings events, we have very quiet movement. And the stock for all last year was in roughly a 20% trading range. Okay. For Yum Brands. And this is a fact. 70% of the time, stocks trade in a range. It's true. I recently had some colleagues that just didn't believe that, so they did their own research. They did their own study on over 4,500 stocks, and their numbers came up with stocks trade in a range 69.9% of the time. So 70%, 70% of the time, stocks trade in a range. So here you have a $20. Yes, it went up and down. You can see it oscillated from high of about 142, 143 down to 127, and then back up to 137, and then back down to 130. Okay, yeah, but that's a trading range. Okay. If it just keeps oscillating back and forth like that, that's a trading range. All right. So this has an average move. Yum Brands has an average move less than 4% over the past four. I can tell you, and it's been even more earnings cycles, moves less than 4%. That's a different strategy right there. Okay. That is not a straddle or strangle candidate. It is definitely something that is different. Now, let me show you an example of a breakout candidate. This is Shopify. Okay. Same time period. Okay. This thing, look at this, greater than a 50% range. Okay. This thing moves around its earnings events. As you can see, these huge gaps. All right. Big gap down, big gap down, big gap up, big gap up. I mean, huge moves. This stock, the last earnings event on this particular chart, the stock closed at $90. The next morning, it opened up about 109. Okay. From 90 to 109. That is a big move. Okay. For a $90 stock. Okay. And this is a stock that Shopify has averaged around 17% move over its past, over the earnings events that you see here on the chart, an average move of over 17%. So that's the difference. You have Yum Brands that has an average move of 4%, Yawner, and Shopify that has a average move of over 17%. That'll get some people's eyebrows raised. Okay, that'll wake you up, going, "Oh my goodness, wow, that's that's amazing," and that happens on a regular basis with many stocks. Okay, all right. So, step 3: review implied volatility, and it's important to know a few things about this. Okay, now IV, implied volatility, is an important consideration, but you just got to know one simple fact here, and I'll get to that in just a second. Selecting options without checking IV values is a common reason that many traders fail at all option strategies. When trying to use straddles and strangles around earnings is not the exception, it is the rule. If you aren't paying attention to where IV is, then you're subject to losing money with trading options, and you need to pay. There are certain strategies in options for certain IV levels. If you have high IV, there's certain strategies for high implied volatility, and there's certain strategies for low implied volatility. Okay. Now, IV crush, I mentioned that word earlier, can eliminate profitability if a stock does not break out. Remember that risk zone I talked about? If your stock doesn't move and you're caught in the middle there, then IV will collapse, and that is where you will lose money on the particular trade. All right. Timing is everything when it comes to this strategy. So I'll talk about timing here. Okay. Timing is important. Now, there's something about IV that I'll show you here in just a moment. So let's talk about visual implied volatility. So charting services will graph out implied volatility just like they will stock price. Okay. There are two lines here, the red and the black. And the black we don't need to pay attention to. That's implied volatility over the past 90 days. And in this example, this is obviously PayPal. Okay. The red line, now what that means, implied volatility over 90 days. What does that mean? What that means is all options like that expire in 90 days or more, like long-term options, leap options. Okay. They're all lumped together. This is their average implied volatility. The red line is implied volatility for 7 to 30 days. What that means is for all options that expire in the next 7 to 30 days, this is the average IV level. Okay. And you'll notice these spikes and collapses in the red line. Well, guess what that is? It happens on a regular basis and it looks like it happens quarterly. Well, guess what? Yes, that's earnings events. Okay. So implied volatility typically rise before earnings events, which can make straddles expensive. Now, I will just tell you right now that with straddles and strangles, with this strategy, yes, we are buying high implied volatility. Yes, we are. We know it, and there's a reason for it. Okay. This goes counter to what you learn in your basic options trading. Okay. There's always asterisks in options education because there's always some exceptions to the rule. And this is one of those rules. We know we're buying high implied volatility and we want that. The reason we want that is because the market makers think this thing is going to move. Well, guess what? We want it to move. So, yes, we are buying that high implied volatility. Now, the IV will drop right after the earnings, which we know. That will make the straddle lose value. That will make the straddle lose value, but not necessarily either your call or your put, because those are in the money and have real value. And I'm going to show you this in just a moment. So hang on. I'm going to show you how this works in just a moment. Earnings moves are often priced into the options, leaving no room for profit. So timing is critical. Okay. And yes, this is where we have to be, use some timing, use some strategy, and utilize these two option strategies, straddles and strangles. Straddles profit faster when the stock breaks out than from implied volatility, typically. And that is true. If we, so on a straddle or strangle, if you trade that, say, a couple weeks out from the earnings event, okay, earnings maybe in 2 weeks, you will need to be in that trade for about 10 to 15 days, or well, if it's 2 weeks, so 10 to 12 days for that IV to really surge going into that earnings announcement, and then you can take the straddle off and take your profit. Okay, this works often, doesn't work all the time, because sometimes the market makers are like, well, we don't anticipate the stock is going to move as much, so IV doesn't get priced high enough for you to make profit. It's eaten away by another Greek called time decay, or theta. Okay, it's eaten up by that. All right. Now, again, we're dealing with two very basic strategies here, straddles and strangles. They require no margin. We're not selling options like doing a spread or anything. It's buy, call, buy, put. Okay, very simple. Now, the time frames. So I just talked about that. Like, timing is critical. So let me talk about this. Review of time decay, and I just mentioned that, theta. Option values decay faster the closer they get to expiration. Okay, if you have basic options training, you know this. Time decay accelerates as time goes on. Theta measures the impact of changing time to expiration. Okay, in a price, in price form, in dollar form. Theta loss, or the rate of decay, increases as the options get closer to expiration. All right. And we use an example. I used to use a piece of paper as an example, wadding it up and throwing it across the room. And at first, the piece of paper, glides along, and then eventually gravity takes over and it begins to drop slowly, and then it's faster, faster, faster towards the end. And that's the same thing with options. Okay. Straddle use at the money options, which lose time value more quickly than out of the money options. And this is where I want you to be careful. And this is why I'm going to talk about timing right now. Okay. This is very critical. Therefore, an understanding of the theta and gamma relationship is important to time our trades. And I'm just going to give you a simple answer to all this. Okay. So, theta time decay in straddles. Let me show you visually what that looks like. All right. So, here's our piece of paper flying through the air. Okay. Boom. So, longer, a call or put option, just a single option, call option, put option, will have a theta decay that kind of looks like this. 90 days out, you don't have much theta risk. 60 days out, you still don't have much, but it's gaining a little momentum. And then finally, about 45 days is your sweet spot. You start getting a lot of acceleration in your theta loss, and boom, it really loses value in the last week or so, last 2 weeks or so before expiration. So here's the thing. That's either a call or put. So when you do two together, when you do the call and put together, you get a little accelerated rate because now you're losing money on two different options. So as you can see here, if you're kind of paying attention, I talked about implied volatility, IV rushing, and now I'm talking about theta taking away value. So IV increases value, theta takes away value. There's your battle. IV increases going into the earnings announcement, but theta is eating away at the time value. That is why the timing is critical. Okay. So there's many strategies that I love doing over holidays. Like, can you believe in January of this year, we only had 2 full trading weeks in the month of January this year, 2025. We only had 2 full trading weeks. And guess what? One of them is this week. Okay. Other than this week, we had 1 full trading week. The other trading weeks were taken up with holidays. We had New Year's on the 1st. Okay. We had President Carter's passing here in the U.S. as another holiday. Then we had MLK Day and on a Monday. Okay. Those were on all different weeks. So really, we've only had 1 full trading week. The others were interrupted by holidays. Those holidays are time. Guess what? Time value gets ticked off over the weekend. It still occurs. You throw a holiday in there, and now you've got 3 days where time decay is eating away at your trade. And if you're not in the right strategy, and trust me, if you're buying straddles and strangles, you probably don't want to be in that position. You want to make sure that you have every day an opportunity to make money, and you really can't when you got all these holidays. So I tried to trade within that 4-day window, okay, during the week around the earnings events. And I'm going to show you this in just a second. So the ideal time frame of this strategy. So let's look at this here. We want to obviously enter there's various stocks where I do like to trade 10, 15 days away from the earnings events. And then there's others where I come right up to the earnings events and I like trading those right around there. Okay. So how close to earnings should you enter the trade, and how far beyond the earnings should you let your options expire? Okay. That's another critical thing. How much time should you put in to your trade? Okay. Like, for example, on some stocks, there are options that expire this Friday. Okay. On the last trading day of the month, which is the 31st. Okay. Then if you want, you could go to the next week if it has weekly options to the 7th. How do you choose? Okay. Well, I'm going to mention that here in just a moment. But if I don't put the trade on 10 to 14 days in advance, about 2 weeks out, then I'll bring it right up to the earnings event because I'm expecting that big pop. Okay. So here on this trade, we want, excuse me, let me jump back here. We want to either exit it before the earnings announcement because we received the implied volatility rush, and I usually look for anything anywhere between 12 and 20% returns on that. And then on the breakout, I'm looking for moves above my break evens, above or below my break evens on my trade. Okay, that's what you're looking for. All right, so let's look at some recent trade alerts. Okay, now as I mentioned earlier, I do this through a service called Delta Neutral Breakout. Okay, again, because straddles and strangles are a delta neutral strategy. We're looking for that breakout. And these are real trades that I provided to our subscribers. And I like using recent data. So I'm going to show you some real recent data, all right, on these trades, okay? So let's begin with one of the more recent trades, okay? So I've got 3 examples here, one recent, one that didn't do very well, and then one that did really well. How about that? Okay, so let's start with Greenbrier Industries. This was a trade that came out. This was trade ID 1388 in our service. This was a strangle. Now, I know this is a strangle for a couple of reasons. Number one, I did the trade. I put the trade out to our subscribers, but you'll notice in the risk graph on the right-hand side, you see these 4 lines, red, blue, and green, and black. Really, you can focus on the black. That's at expiration. The other lines deal with time. Okay, the red is one third is today. The red is today. Okay, the blue is 1/3 timed expiration. The green is 2/3 timed expiration, and the black is at expiration. Okay, and so here with the flat bottom, see how the black line, the bottom is flat. Okay, that tells me I use 2 different strikes, because anytime the risk graph changes direction like this, there is a strike price involved. This was a strangle using, it looks like the 60 strike and the 57 strike. We'll see here how this did in just a second. So Greenbrier was a stock that, well, you can see here the last earnings event. Okay, see the little green triangle there? Look at that stock, how it just jumped up, big move in the stock. And then it had 2 follow-through days before a little pullback, and then another gap up on different related news, okay? That was back in the fall, all right? But again, this was issued on January 8th, okay? Just a few weeks ago. The debit here was $4.50. Now remember, with these trades, you multiply everything by 100. So we talk in, if I say 25 cents, that's, $25. So here, $4.50 is $450. Okay, that is the debit per strangle in this example, per strangle. So most people are trading with, if you're dealing with a $10,000 trading account, well, this is $450. You probably just want to do one strangle. That would be 4.5% risk on portfolio. Okay, very reasonable. Very reasonable. Now, if you had a $50,000 trading account, well, then you might want to do 4 or 5 of them. Okay, just to equal that. I don't want to risk typically more than 5% at the most in any one trade, just to, because I like, trading is all about numbers, okay? No, all about events, and you want to keep your numbers up. If you won't, guess what? People say, well, I took 5 trades and only 3 of the 5 worked out. That's not a good data pool. For a trader, a good data pool starts in the hundreds of trades. Hundreds of trades. The number, we call it numbers of occurrences. We need a lot of occurrences, okay? And guess what? I have a lot of occurrences. Each and every year, I have hundreds of occurrences each and every year. Hundreds and hundreds. Okay, so the alert went out January 8th, and then let's see how this thing did. Okay, look at this. The stock did not gap up how we thought it would. You can see the little triangle there. We got a little gap move. So what did we do? Well, because we had a little bit of time left in our trade, well, only 3 days, we hung on to the option. And, 2 days later, with 3 days left, we finally popped up into the profit zone. My target was actually $68. That's where I thought the stock would go. It got close, but I was running out of time. Okay. Again, this was a case of, in my opinion, I did not use enough time on my strangle. With 3 days left to expiration, I exited the trade. Okay. On that bar there, the dark blue line is slicing through price at the close of the day, but you can see there's a little wick on top. So when we exited the trade, we exited it at $6.48. That's $648. And that would be a 44% return on risk in 6 days. Okay. That's a profit of $198. Now you're like, oh, $198. Well, that's not very much. Well, on a $10,000 account, that's just under 2% return in 6 days. A 2% return on portfolio. You annualize that out, and wow, wow. Okay. So, and again, if you're dealing with a bigger account, you're probably dealing with additional straddles or strangles in this case. You probably did 4 or 5. I know people that do 10, 15, 20 or more. Okay. And the numbers just grow exponentially, right? Okay. So I call this, hitting a single, honestly, hitting a single. Maybe close to a double, but definitely a single on this, using a baseball analogy. Okay. So to review there, the entry was on the 8th of January. The exit alert went out on the 14th of January. And I send these alerts out through SMS messaging. So directly to your phone, you get a little phone alert, and through email at the same time. They hit at the same time, just so you know. Okay. All right. So let's look at another one. Let's look at Jabil. Jabil Circuit, JBL is the symbol here. Now, this is trade ID 1372. This was a straddle. So on the black line, you can see we have our 4 lines there that represent time. The black, as you can see, it goes into a point. We call that the witch's hat. If we turn this trade around, you kind of have that witch's hat look there. And again, if the stock goes up, I need this stock. The light blue lines here are my break evens. If you see these horizontal light blue lines that go across the chart there, those are my break evens on the upside and the downside. So my upper break even is around 148, and my lower break even is around 122, 123, somewhere right there. So this alert went out on December 17th. Now, in the month of December, this was not earnings season, but the thing is, earnings season never really ends. You have the heart, like this week, as an example, we have 411 companies declaring earnings this week. 411. I'm analyzing 84 of them, just so you know, as a comparison. The rest I don't care about. Why? Optionality. How options trade on them. So I focused on 84 of them. Of the 411, the other 400, the other couple hundred, I don't worry about. All right. So we have that going on right now. But, at the beginning of January, we only had like 24 in a week. In December, we only had a handful of companies trading. But guess what? Even in that handful, there was great opportunity. I'm going to show you one here. I'm going to show you the next two these two are examples of that. All right, so here's the result here. Stock gaps up. Now, let me pull this back. You see the stock opened up. Now, these use candles. So the stock gapped up here around 148 and change. You see the wick. It went above 149. And then, look at this, sold off during the day and closed lower. All right, so the alert, this is why alerts work. The alert went out first thing in the morning on that gap up. Jabil traded higher, allowed our traders to take exits on the trade. We exited this trade in the morning. Okay. The alert went out at an exit of $13.89. Okay. Or $1,389. That was a profit of just $219. That was a 19% return in 2 days. Now, I think it skipped a slide there on the box, but the debit here was $11.70. Okay, so $1,100, $1,170. So some of these do get expensive, and that's why accounts that are a little bigger, 20, 25,000 and up, are usually best for this. You're taking a lot of additional risk if you're trading some of these with smaller accounts. I put out a lot of alerts that are $600 and less. So if you have a smaller account, that's definitely what you want to trade with. For like Greenbrier, okay, was a great example. These trades I call high value trades because they have a higher dollar amount. But man, do they pay a lot of times. This one just paid $219 on the exit, okay, which was a 19% return in one day. Okay, the alert went out on the 17th. The exit alert went out on the 18th, and then we exited that trade and just had a few days left. I didn't want to wait with that. With the stock coming off of its highs is when the alert went out. So right around that 149 level is where we exited this trade. All right. Now let me show you the power of this. So we exited this trade on the 18th, right? But also on the 18th, I sent out another alert on Micron Technology. Okay. And again, this was the 18th of December. While everybody's focused on Christmas, everybody is looking at Christmas plans and going shopping, I'm behind the desk and I'm trading. Okay. And I'm seeing that, man, there's some opportunity here. Now, you'll notice here, if you're paying attention, I did this trade. Okay. Micron had earnings after the market closed on the 18th. I put out this alert, trade ID 1375, which you can see on our website, on that day. Okay. It was a day order only. Okay. Going out, and I used options that expired in 2 days. So I took a little bit of a risk there. I don't do this very often, using options that expire in the same week. I don't do this very often because I want time on my side. But I did this to control the debit. So this was another high value trade at $1,083. Okay. $10.83 for this strangle. Okay. And people think, oh, this is expensive. Well, let me show you what this thing can do. Okay. So then after the market closed the next day, look at this. The stock closed down 16%. In fact, it traded, you can see the wick on the candle. The stock traded down below $86. Look where we are. The dark blue line represents closing price, and you can see where it is on the risk graph out there, over $1,000. But we exited, of course, as I'm watching this, and the stock started to rally off the lows. That alert went out right around that $86 level. Okay. Right around that look at that gap down. Beautiful, beautiful move on Micron. We were able to exit just the day later at $22.38. That's a $2,238 profit, or excuse me, credit, $2,238 credit, which is a $1,155 profit. So 107% return in one day. That's the power of options, and that's the power of breakout trades. All right, so to kind of show you how this goes, this is a screenshot of our members area in the trade summaries where we have the trades, and you can see that even before we got into the heart of earnings season, we had a nice handful of trades. GE up there. Well, let's start at the bottom with Oracle, and I'll work my way up. Okay, Oracle at the bottom of this, was a small win. Okay, 53 cents, so $53. We did take some heat on that. You can see that I kind of had to wait. We were in that trade for 8 days, but in the end, we made a little profit. The next trade, trade ID 1373, which is TTC, that's Toro. The lawnmower people, boy, they didn't do me any favors there. A small loss of $285. Okay, that is real. In reality, that's a small loss. $2.85. 2%, 2.8% on a $10,000 portfolio, easy to recover from, especially when you kind of look at these results. JBL, trade ID 1372, that was taken on December 20th. or those were options. Sorry, 20th of December was the expiration date. Taken on the 17th of December, exited on the 18th, along with um, um, uh, Micron and some of these others. The credit there was the profit there was $219, an 18% return in literally 24 hours. Same thing with Micron. You already saw that. Nice double digit. I consider that a home, at least a triple, if not a home run on a anytime you get over 100%. Okay, and then GBX, which is Greenbrier, I showed that in the example. That was a 44% return, $200 in about 6 days. And then finally, GE, which is one of our most recent trades. We put the entry on January 22nd and exited on the 23rd. Of course, here we are on the 28th, so that was just last week. And that was a 74% return, $733 of profit in General Electric for that particular breakout. All right. So this is something that we do on a regular basis, and we're in the middle of earnings season right now. So let me talk about, in summary here real quick. We have straddles. We're using straddles and strangles. So no margin is required. That's simple buy, call, buy, put. Sometimes they're at the same strike price. Sometimes they're at two different strike prices. One strike price for the call, one strike price for the put on a strangle, always the same expiration date. Okay. I send out the trade alerts via SMS, so text alerts, and via email. We do live trading sessions. I do 4 of them during the week. My colleague Rob Roy, who's not pictured here, also does at least 4 during the week. We do a session called Insiders on Thursday nights, where Rob and I review all of our trades and analyze the markets. Okay. So real-time trade alerts, website access, insider meetings. We do, of course, do a lot of education here. And I want to do something different for you. I want to introduce to you Stephen Camp in the bottom right. There's a little picture of Stephen. You can email him at stephen.camp@ewotrader.com. Stephen is the head of account services, our account services team. And we want to handhold you through the process and through our education and get to know us. Okay. Rob and I have been colleagues. I've known Rob now for over 25 years, and we are colleagues, and we love our, dealing with our people, our customers, our subscribers. You can also call Stephen at the number listed there, 312-637-2249. That's 312-637-2249. And you can reach Stephen directly. And Stephen will help you with Delta Neutral Breakout. Again, that's the name of this service that we've been talking about today, and about this strategy that we've been talking today, using straddles and strangles around earnings. And again, that's not even counting other events. There's technical patterns in charts where you can use a straddle and strangle. You want to know the secret to that? I'll tell you. Give yourself enough time to be right. That's all. Give yourself enough time to be right when you do that. But earnings gives you the date, gives you the time. It's, it's great, okay, about earnings. And I have a different service for those quiet stocks. Stephen can introduce you to that and talk to you about that as well. But so instead of just a random link that takes you to a random web page, and we want to talk to you. We want to learn about you and learn about what your trading needs are, what you're looking for, what you're expecting, your struggles, your triumphs, the whole deal. Okay. So that's it for today. And David, I didn't quite get there to the top of the hour, but we got close.
Yeah, it was a great presentation. So thank you for being. I'm gonna type the phone number in there too. Was it 312? Okay, so yeah, the contact info is there.
Great.
All right, so any other questions for Jeff?
Do you have any? If not, that's good. That's good. That means we did
Can
a
you
good
see the
job.
chat?
Oh no, I couldn't see the chat. I'm sorry. Can
Um,
you read it? You want
yeah,
to read one of the questions to me?
I think you might have just answered this, but how much is the service?
We talk to Steven because I could quote you. Trust me, it's not very expensive at all. But he's the deal maker and he has authority to work with you on that. But it's for delta neutral breakout. We can get you down to um, a very good low price on the service. So give Steven a call or email him if you don't like talking on the phone. Email's fine. So
Um, oh, okay. So what about profit factor, win rate, and hold days?
okay,
And how many alerts per week? That sort of thing.
so that's available on our website. We have I can tell you uh, in 18 months since we launched the service, the returns were 2.7 times original investment on the service. That is on our website. That is posted at ewotrader.com. Hold time for the average trade is only about 4 to 6 days. I would say it's closer to 4 days on hold time. So this is pretty active. And in fact, I sent out 2 trade alerts already for my customers. I sent out 2 new trades and 1 exit before we came online today because we're in the middle of earnings season. So we're really active right now.
All right. Oh, yeah. I'll They asked about your site again, so I just posted that. So, um, all right. I think that's it for the questions right now.
Okay,
So I'll
fantastic.
post, yeah, Steven.camp at ewotrader.com. I'll post that again for everyone. And, all right. Thanks, Jeff.
You're very welcome. Have a great trading day. Everyone have a great trading week, and we'll talk to you again soon.